Hey everyone, and welcome back to another video for today. So as promised, quick update on Oscar Health, also a little bit on UnitedHealthcare, as well as both of these stocks have been moving a little bit on the upside. Both of these companies did provide us with a little bit more information on this year guidance and 2026 as well. Oscar right now is trading at $90 and let's call it 50 cents, $5 billion in market cap. Year to date, the stock is up 43.8%. And over the past month, the stock is up 24.9%. Now, more recently, they were at the Wells Fargo analyst conference and they did provide us with a little bit more information. But one of the big reasons why Oscar and UnitedHealth went up, especially Oscar, is because of this House Republican launch bill to extend health subsidies past midterm. Now, again, this has not happened, but this is, again, the latest sign the GOP sees political peril in letting enhanced ACA tax credit expire at year's end. Now, for Oscar, for UnitedHealthcare, we of course already got guidance, especially for Oscar. Guidance does not include the extension of ACA credits. It does not include that, which means that if it does get extended, then that's pure upside. But there is, of course, more information. So let's talk about all of that in this video. If you enjoy this type of videos, hit all the buttons. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so at the start of the month, there was the Wells Fargo 20th Annual Healthcare Conference that was September 3rd. And so they told us the following thing. With regards to medical loss ratio, that is anticipated to increase in the third and fourth quarter, with second half seasonality expected to align more closely with 2023 dynamics than 2024. Revenue guidance was raised, driven by an expected higher volume of member months in the second half of the year compared to the first half, despite a projected modest decline in overall membership by year end from the second quarter. The company maintains a strong capital position with significant excess capital and parent cash, coupled with very low leverage, providing adequate resources for funding in various scenarios. Then, utilization trends have continued to moderate into Q3, now almost back to what was expected for the risk in the book, significantly reducing anxiety about core performance. Very good signs. After this, stock went up a little bit. The impact of members losing subsidies due to dual enrollment and failure to file and reconcile has been modest and immaterial, with the risk characteristics of the departing population being neutral to slightly positive for market morbidity, contrary to earlier concerns. So here again, better than feared. The company adopted an aggressive pricing strategy for 2026, stacking multiple risks, including a high-end historical trend, the potential expiration of enhanced subsidies, program integrity measures, and the 2025 market morbidity shift. The objective is to balance market share growth with a clear path to profitability and meaningful margin expansion, rather than prioritizing hyper competitiveness. Now, what about the upside? So, while 2026 pricing assumes the expiration of enhanced subsidies, the company views a potential extension as a net positive upside to financial performance. There is cautious optimism for an extension, likely tied to a continuing resolution, even if it occurs later in the year or during open enrollment, with brokers and regulators expected to facilitate enrollment. And then the last couple of things here, the individual, so ICRA in this case, this market remains a key focus, with continued investment, including recent asset acquisitions and new partnerships like Hy-Vee. It is projected to be the fastest growing sector in the individual market long term, despite near-term pricing fluctuations. And so all of this has been seen as for the market as a positive thing, meaning that the bottom for this company, maybe the biggest fears, are behind us, and now it's up from here. Now, up from here, of course, there are two scenarios, either the scenario from the guidance, which is just what they told us, or maybe accelerated growth ahead if the enhanced subsidies will be extended. Remains to be seen. Now, also remember, if we go back to the Q2 earnings report and call, they didn't change anything with regards to the 2027 guidance. So that didn't change. So the company maintains its long-term of 5% margin and $2.25 of EPS for 2027. If of course that will change, of course on the downside, then I do think that the stock will take a hit. But as long as there are no changes to that, let's call it now midterm guidance, I think we're good. I think we're good, and I think this company could actually beat it. This is a company that is highly efficient. This is a company that has adopted AI. It's also featured, I believe, in the, maybe not the last one, but the one before that, the OpenAI presentation. I do believe that Oscar was featured during that presentation. And so I'm not surprised to see Oscar go up 21% or so since the start of the month. And actually it went up a little higher than that, went up 30%, but we've seen a small pullback from the $20-21 or so this week. But I'm not surprised that this is happening. It was also a little bit overbought the last couple of days, but now we're back here around $19.50 or so. As you can see, it also filled that big gap right here that happened back in July. That big drop did get filled, and now we're just pulling back a little bit. To me, those are healthy pullbacks. Now, what am I doing with my shares? I bought more shares of Oscar right after the first big candle, so right after we did get confirmation that, okay, things are a bit better than previously feared. With this one, also, I have no issues averaging up. As long as I get positive information from the company, from management, or maybe the enhanced subsidies are not expiring, I will keep adding and I will have no issues adding and, well, averaging up. Why would I? It's still just a $5 billion company. I think the market is quite huge, and I do think that Oscar could become a multi-bagger in the future. Of course, with this one, yes, external factors could impact a company like Oscar, but I do believe that management have things under control as much as possible. As for UnitedHealth, as you can see, is up 50% from the bottom here at the start of August. And over the past month or so, the stock is up 17-18% and has actually accelerated over the last couple of days here. Right now, we are also seeing that the stock on the daily here is overbought. Now, the stock right now is, of course, still experiencing a 43.2% drawdown from the peak that was November 2024. It's a company worth $314 billion, trading PE 15.1 times, forward PE right now 21.7 times. So the forward one is higher than the trailing one. Now, what happened with UnitedHealth more recently? Well, we've had some comments from UnitedHealth, and then we've got a lot of analyst commentary, and most of them have an outperform rating, buy rating, and price targets that were previously higher than the stock is at right now. So for example here, Bernstein, outperform rating, price target $379. So UnitedHealth sees 78% of MA members in a 4+ star plans for 2026. The result compares with 69% and 77% in 4-star plans in 25 and 2024 respectively. United Healthcare indicated that performance was in line with historical results. United Healthcare still expects fiscal year 25 EPS of at least 16%, so here reiterating guidance was enough for the market. The company noted that the outlook, which was established at the second quarter earnings on July 29th, includes the closing of the Amedisys acquisition this August. Their thoughts, the analysts thought here, this is a good outcome for United Healthcare. Investors have been focused on 3 major near-term risks. 1, concern that United Health may take more cuts to guidance as the new CEO cleans up base earnings. 2, that a surprise hit to stars would have hit the 2027 earnings recovery. And 3, DOJ risk related to MA risk adjustment and vertical integration topics broadly. United Healthcare's 8K helps to address number 1 and number 2 of these concerns. We think that this is not the improvement that is important, but more so that investors may see reduced near-term uncertainty and may be willing to move into the stock before the third quarter earnings. Previously, investors might have been more likely to wait until after stars came out in October to invest in United Health if the risk of stars losses were still pertinent, which again goes back to what I said before. In these types of situations where the company looks cheap, the company has taken a huge hit, or the stock has taken a huge hit, there are just times where being better than feared is good enough for the market. And I think that's what we've seen right now, especially with UnitedHealth and with Oscar. I think there are probably some other names in the market where we've seen the same scenario. Better than feared is good enough because the stock has been hit so much that it is an overreaction. And so investors, buyers are coming in. There are now way more buyers than they are selling, which is why we're seeing the stock go up. Yes, stock market 101. I know, incredible. We also had Morgan Stanley. They reiterate their overweight rating on UnitedHealth with a price target of $325. We are incrementally positive following discussions with United Healthcare Management, where it had conviction in the turnaround driven by MA and Optum Health profit improvement. They maintained MA pre-tax margin progression of 2 to 2.5% in 25 and 2.5 to 3% in 2026, supported by rebased bids, with potential to reach high end of 2 to 4% by 2027. It expects a lower retention in MA versus the historical 1/3 for the 600,000 lives impacted by plan exits, and encouraging dynamics as it prioritizes margin in 2026. Now, the 2026 MA memberships in 4-star plans should improve to 78% or better, as we've just discussed before, up from 71% this year, enhancing the visibility on the MA profit recovery, aiming to achieve the long-term pre-tax target margins of 6 to 8% by 2028, driven by Optum Health's improved operations, reduced risk, and VBC TAM expansion. And VBC means value-based care. And so right now, of course, with the stock moving quite aggressively more recently, some of the price targets are, of course, lower than the price that the stock is at right now. And that's fine. That's fine. I do think that here, again, the narrative might be changing. And here, as you can see, there was a gap that happened back in May 2025 that is slowly but surely getting filled. We're now halfway there. So to close that gap, the stock would have to go to around $380. Once that closes, maybe we might see a pullback in this name. This is a name that I own as well as a more defensive value play. Oscar, I do own because of the multi-bagger potential, but I do also think that UnitedHealth, if you have a good average, if you bought here or even closer to 300, I do think that you will have market-beating returns in the years ahead. I don't know when it will go back to $600. It will probably take some time, but I do think it will reach that number eventually. And so in the meantime, you can collect a dividend. And in the meantime, if you like what you see, you can even add more shares. So all in all, that's about it. Oscar, I will want to grow my position because I do see the multi-bagger potential there. United, I'm okay with the small position that I have. We'll see how that plays out, how fast we can go up. But that's about it. That's the quick update from me. If you've been buying more shares of any of these companies, do let me know down in the comment section below. Like, subscribe, all of that, and I see you all in the next one. Bye-bye.